Joining me now for a closer look at what's playing itself out in that market scene is Gary Booysen from Ransford. Gary, a pleasure. Good afternoon.
Good afternoon. Thanks for having me on.
Thank you so much for being with us today, Gary. All right, it looks like just jitters, Gary, volatility. Some days we're up, some days we're down. It really just looks like market participants are battling to find some form of direction. I'm keen to get your thoughts on what we're seeing on our screens today.
Well, maybe it's early sell in May and go away because we're heading to that time of the year, and we have had an absolutely stellar start to the year as well. So we're moving to the US earnings season, but at the same time, I was looking just if. Yeah, I mean, the index return this year has been absolutely spectacular. So I think a little bit of profit taking, a little bit of jitters moving in this week, it makes sense. I mean, obviously, we've had an escalation of tension across the Middle East as well. The real move in the currencies have come from the US inflation picture, which inflation is not coming under control as fast as everyone had expected. I think the market is trying to now adjust to the idea that we're going to have higher interest rates for slightly longer. And that's obviously equity negative. So the fact that we're up as strongly as we are year to date, certainly in international markets, it does feel a little bit overdone. And I think people may be looking for an excuse to sell off the equity markets.
I think the IMF actually came out to say that they believe that corporate valuations are high and do pose a risk on, the global markets there, Gary. But what we're not seeing is upbeatness here at home. In fact, last week we had a great commodities rally here. But this week it's literally been the opposite. I saw now they're up just over 1.5%. What is happening with market participants and their thoughts around commodities here in South Africa?
Well, I think, remember, a lot of our commodity companies are, they're driven higher by the dual listeds as well. So, South Africans have fantastic access into international commodity markets through the JSE. Now, if I look at it, as you said, the resource index up, we'll call it it's 1.67% on my screen at the moment. And that's really being driven by a couple of factors. So obviously, you already mentioned at the top of the show, the rough diamond sales for De Beers, that lifting Anglo American up, well over 3.5%. We also had an upgrade from JP Morgan around Sibanye Stillwater. So they've upgraded their target price to $7 a share, up from $5 per share. We also have a copper update out of Peru around Glencore. That stock up over 2.5%. So a little bit of underlying news flow just driving some of these commodity companies higher. And as I said, I think fantastic entry point for a lot of South African investors. We look at a lot of international portfolios as well as local portfolios, and I always it kind of surprises me that in the international portfolios you find the common South African names listed on our exchange. You're externalizing funds to go and buy Anglo and Glencore, Anglo American and Glencore. I mean, do this in your local portfolio. It doesn't make any sense. But I think nice access for South African investors, and I think if commodity prices start to move a little bit higher, and we're definitely seeing that as well, that should add a little bit of a tailwind.
I must ask you also about what we're seeing in England today, Gary. We've seen inflation come down. I think it's at 3.2%, better than expected here. We are expecting that the governor of the Bank of England will speak a little bit later. What are we seeing happening in that part? Is it possible that England might see fundamentals that lead to cutting sooner than what we might see the Fed?
Well, I don't know. They're only pricing in one cut from the BOE this year. So I think the Fed is still pricing around 2. And I mean, that's down from 5 when we came into the beginning of the year. So again, just the narrative that, we're going to be higher for longer, really moving into the market in a big way. Looking at that CPI print this morning, 100%. So the actual number at 3.2, was above the polled number, at 3.1%. Just that's on the year-on-year figures. But, again, it comes down to the services. We've seen a huge moderation in goods price inflation across the world, but the service price inflation is just, it's so persistent, and that's really where you're going to find embedded inflation. And, looking at the CPI numbers in the UK today, I mean, service inflation, expected at 5.9%, coming in at 6%, prior at 6.1%, the service inflation is still high. There's, you can completely understand why there's only going to be a 25 basis point cut, priced into the market at the moment from the BOE. I mean, and yet at the same time, we're still at 16-year highs. I mean, this is a difficult picture for equity market investors to digest. And like I said, that kind of, it makes sense for me that we're getting a little bit of selling pressure at the moment. I mean, this is not good news. This is starting to talk about stagflation.
Yeah. And are we seeing, profit taking, Gary, and people fleeing equities, moving to bonds, maybe even keeping cash here? We're seeing gold rally really strongly. Are people possibly moving their money towards hard commodities?
I think a lot of the gold price run has come from the central bank buying as well, and I mean, you see huge central bank buying, across I suppose the BRICS nations. We've seen like the Iranian central bank buying. China, I saw a stat the other day. I don't want to almost say it on air because I don't know how reliable it is, but I think China, China, like I mean, I definitely read it as China now accounts, I think, for 2/3 of the gold buying of all gold output at the moment across the central bank and private buyers. Now you need to check that stat, but I mean, definitely China a big buyer. I think they bought something like it was a huge volume of gold as well. And so I think that's where that's coming from, more than maybe investment managers, shifting portfolios towards gold as more of the traditional kind of risk off safe haven trade. Although if you look at something, I mean, the dollar index is going absolutely berserk at the moment. I mean, up to 106. That also on the back of that CPI number on the 10th of April. So with the miss there on the Fed, that's where you sort of seeing the dollar strength coming back in, the idea that you're going to earn a yield. But if you look at the Japanese yen, you look at the Swiss franc, you look at the US dollar compared to gold this year, the right safe haven to have been in is absolutely gold.
Very, very interesting times that we're seeing here, Gary. It looks like a back to basics kind of a story there. I'm keen to get your stock pick in a bit, but first I'd like us to reflect on counters that have found favor with your industry peers.
Transaction Capital is my stock pick tonight, Julieta, which might be a little bit of a strange one because we've just had the We Buy Cars unbundling. But that is exactly why we've seen Transaction Capital shares, the rest that is left over, which is basically Newton, a debt collector, and then a ring-fenced SA taxi business, and some cash at the head office. The share was down sharply today. And that's to be expected because a lot of index funds and retail investors, institutional investors ended up after the We Buy Cars with, call it, a 2/3 holding in We Buy Cars. And there's 1/3 of this thing left over that you have nasty nightmares of being Transaction Capital. And everyone has been selling their Transaction Capital the moment they could from yesterday. So at some point, I think the selling will subside, and this is their opportunity to get in, because I do expect that Newton will be stabilized now. It might even not be listed a year from now if the management team does a management buyout or something like that. But I do think that it's worth double the current share price. Sure. And as long as this forced selling subsides a year from now, things might look very different for Transaction Capital.
I suggest that we buy that dirty fossil fuel company Shell, which is London listed. I think at the time it was £12. The oil price was in the doldrums. And sometimes it's nice to close the loop. I think we said it was a tactical thing. We weren't, we just felt that it was worth more. It's sitting at about £28 or thereabouts. In this 3 or so years, you probably earned £3.5 worth of dividends. So, I'm in the camp that says that fossil fuels are in their sunset phase. You can just see the explosion in EV, for example. So at the margin, I believe that demand will start to taper off for the products that they produce. And against that backdrop, I would argue that, 5 or 10 years from now, you definitely don't want to be owning these fossil fuel companies. So we've made good money. It's been rewarding, and particularly because of the spike courtesy of the Middle Eastern tensions and OPEC, the oil price has kicked up, and that's taken the share price higher. So I think it's a good time, if you followed that recommendation. And if you don't want to sell all of them, sell 60%, you're left with a free ride. And but it's been quite kind, and I think it was a good opportunity for us way back then.
All right, keen to get your thoughts on some of those, Gary, Transaction Capital and Shell.
Sure. So Transaction Capital, I mean, I totally understand the idea behind it. Typically it's Yeah, what is that? So a great, I think it was a quote from the Finance Ghost. It says, this is the moment when all the value investors and the growth investors divide into two lines, and either line up if you're a growth investment behind We Buy Cars, and if you're a value investor behind Transaction Capital. But I think, so much of investing in equities is around understanding the sentiment that is playing out. And, I think, to understand that Transactional Capital is essentially the leftovers, and We Buy Cars is the exciting jewel that everyone is excited about buying. And typically, in markets, if it's in the press, it's in the price. So it does look like there could potentially be value in Transaction Capital. I mean, certainly from a market mechanics point of view, it makes sense. Especially because they've just raised a whole lot of cash to solve their problems by unbundling the We Buy Cars segment of their business. Now, I think the only kind of counter argument to that is to say that interest rates are going to be high for a while, and that SA taxi business, I mean, you're financing taxis and in a higher interest rate environment, that's where they ran into trouble. So you'd expect, obviously, like the lending criteria to be more stringent. But I think it's a difficult space to operate in. If they make it through, and by all accounts they should, I mean, I think they've still got a decent stake in We Buy Cars that they could potentially sell down now in the listed space. There's a float. You can sell those shares into the market, and that that could potentially prop up the company, a little bit more. And why not? Yeah. So if Transaction Capital makes it through the rate cycle and we see interest rates starting to come down again, why would you not expect this to go a lot higher? So yeah, I definitely like the idea, although we don't hold Transaction Capital in portfolios. We haven't ever held it in portfolios. And then Shell, interesting, obviously, having held Shell for a long time and then selling down, on the long-term view, absolutely, it's a valid point. And I think one thing to say around that is that often, as stocks fall out of favor, the investment appetite for sinking new wells and developing oil and gas projects, etc., that drops off before real demand drops off. So the commentator was talking about a 5 to 10 year time horizon where we'll be moving away from these sorts of energy companies. 10 years is a long time, especially in the world that we live in now with AI and all sorts of things. I think and Shell is quite advanced in its transition towards a greener future and looking at alternative energy sources, but also if investment is dropping off, I think you could have higher oil prices for a longer period of time. And if that's the case, then I think you might still do fairly well out of Shell. So I'd probably go the other way on Shell, and I would hang on to it for a little bit longer.
Well, that said, Gary, which count are you loving this afternoon?
Okay, so this is not one that we hold in portfolios, but it's actually something I bought last night. Okay. So I was looking for a low stock price, would you believe it, type of company. So I bought Lyft. So if you look at Uber's share price, it's gone absolutely berserk over the last little bit. And I think the idea is that if we get full self-driving in the next couple of years, these ride-sharing apps are going to do exceptionally well. Now, Lyft is a very different company from Uber. And like I said, we haven't put it into client portfolios. This is a little punt on the side that I've taken myself, mainly because I'm just upset that I didn't get in on the Uber rally. And it is a very different company. It's very focused on the US. It doesn't have the spread of products like Uber does. In terms of Lyft is very focused only on ride sharing. It's not focused on food delivery and moving parcels around, etc. But I think it will also be a beneficiary of a full self-driving future. And it is a lot cheaper than Uber at this stage. So if you look at the relative between the two charts, I'm saying that there might be a little bit of a catch-up still to be done on Lyft. And like I said, but it is a punt.
Well, it's a pleasure having you with us this afternoon. Gary, thank you so much for taking us through the markets. That was your midday markets update with Gary Booysen from Rand Swiss.